All right, picture this. You're buying a house, but you never once have to step inside a bank. I mean, no rigid loan officers, no mountains of paperwork. Sounds kind of nice, right? Well, today we're going to break down a really cool strategy that makes this whole thing possible. It's called seller financing.
I mean, if you've ever felt that frustration, the endless paperwork, the super slow grind of getting a traditional mortgage, you are definitely not alone. But what if there was a more direct path, a shortcut, kinda, to owning your own home? So here's what we're going to cover. We'll start with what this other path is all about. Then we'll talk about how the seller becomes the bank. After that, we'll get into the real nuts and bolts. We'll look at 4 different flavors of this kind of financing, and finally, we'll wrap up with how you can decide if this is your move. Let's jump in.
Okay, first things first. Let's really explore this other path to homeownership. What does it actually mean when a seller decides to finance the deal themselves?
So what are we talking about here? It's actually pretty simple. Seller financing is just a deal where the person selling you the house is also the one giving you the loan. You're cutting out the middleman, the bank. Instead of sending your monthly payments to some giant financial institution, you're paying the seller directly. It's a total game changer in how the deal is set up.
And that really brings us to the core idea here. The seller literally puts on the banker's hat. So let's put these two models side by side and see how they really stack up in the real world.
And the difference is, well, it's night and day. Think about it. A traditional mortgage, it's slow, it's rigid, it's standardized because you're dealing with this huge, faceless institution. But with seller financing, you're dealing one-on-one with another person. And what does that mean? It means things move way faster. And, this is the big one, you get so much more flexibility. All of a sudden, everything from your down payment to the interest rate is on the table. It's all negotiable.
Okay, so if you've cut the bank out of the picture, what actually holds this whole thing together? What makes it legit? Let's get into the nitty-gritty, the real nuts and bolts of how these agreements work.
Right. How do you make sure a deal like this is solid and secure for everybody? Well, it really boils down to 4 key pieces of the puzzle: a promissory note, some form of security, a clear path for the title transfer, and, this is a big one you'll see a lot, a final balloon payment. Let's take a look at each one.
First up, you've got the promissory note. You can think of this as the heart of the whole deal. It's the official, legally binding contract, the rule book, really. It spells out everything you and the seller agreed on: how much you're borrowing, the interest rate, and, super important, exactly what happens if you can't make a payment.
Okay, next up is security. Just like with a bank loan, this loan has to be backed by something valuable. And in this case, it's the house itself. That's the collateral. So if the buyer stops making payments, the seller has the legal right to foreclose and take back the property. Pretty straightforward.
And this is where things can get really creative, which I think is so cool. A smart seller might add extra protections. For example, they might require the buyer to get something called mortgage protection insurance. And this is a fascinating little detail because it actually protects both of them. Think about it. If the buyer loses their job or becomes disabled and can't pay, the insurance kicks in. The seller still gets paid, and the buyer, amazingly, gets to keep their home. It's a win-win.
All right, now, beyond these clever protections, there is one giant component of these deals that you absolutely have to be ready for, and that is the balloon payment. This is a critical piece of the puzzle, so listen up. Because these are usually short-term loans, they often end with a massive, lump sum final payment that covers the entire rest of the loan. A buyer has to have a rock-solid plan for this day, whether that means saving like crazy or, more likely, refinancing with a traditional bank before that big deadline hits.
Okay, so now that we know the basic ingredients, let's see how you can mix and match them. It turns out there are a few common flavors of seller financing out there.
This chart gives us a really nice quick overview. You've got a land contract where the seller hangs onto the title until every last penny is paid. Then there's the assumable mortgage. This is where a buyer can literally take over the seller's existing mortgage payments, though this usually only works for certain loans like FHA or VA. Rent-to-own is pretty much exactly what it sounds like. And then you have this interesting one called a wraparound mortgage, where a brand new loan gets created that wraps around the seller's old one. That one's a little more complex, so let's zoom in on it.
Yeah, that wraparound loan, it can sound a little confusing at first. So let's break down exactly how it works step by step. Okay, so here's the flow. Step 1, the seller already has their own mortgage on the house. Step 2, they create a new, slightly larger loan for you, the buyer. Step 3, you make one single monthly payment directly to the seller. In step 4, the seller takes that payment, uses part of it to pay their original mortgage, and then they pocket the difference. Pretty clever, right?
But wait, there's a potential landmine here, a major red flag. Most regular mortgages have something in the fine print called a due on sale clause, and what that means is the seller's original bank can legally demand the entire loan be paid off in full the second that property changes hands. A wraparound deal could absolutely trigger that clause, and that would create a massive, massive problem for everyone.
So how do you get around that huge trap? Well, the smart play is to structure the deal to defuse that bomb from the very beginning. You make sure the agreement is written so that money from the sale is used to completely pay off the seller's original mortgage right there at closing. Boom. The due on sale problem just disappears. The deal is clean and secure.
All right, we have covered a ton of ground, so let's pull it all together now. It's time to really weigh the pros and cons, the big trade-offs, so you can start to think about whether this path might actually be the right one for you. So here's the bottom line, the core trade-off. With seller financing, you gain incredible speed and flexibility that a bank could just never match. But, and it's a big but, the trade-off is that you are agreeing to a much shorter loan term, which, as we've seen, almost always ends with that giant balloon payment looming on the horizon. And don't underestimate how important that shorter term is. We are not talking about a comfy 30-year mortgage that you can just set and forget. Nope. Most of these deals are built to last somewhere between 5 and 10 years. That is a much shorter runway to get your financial life in order for that massive final payment.
So, in the end, it all comes down to this question. Are you willing to trade the long-term comfort of a traditional mortgage for the short-term speed and flexibility that could get you into a home years sooner than you thought possible? Make no mistake, it's a high-stakes trade. It requires real discipline and a solid plan. But for the right person in the right situation, it just might be the key that finally unlocks the door to your own home.